Sajjid Chinoy, Chief India Economist with JP Morgan, is joining us on the show now. Sajjid, good morning. Good to have you with us here as always. Appreciate your time. What are the two or three most frequently asked questions put to you by investors now that the budget has been is behind us and people have had some time to sort of look at it in some detail? What are the top questions you're getting?
So I think the top question was, what was the reason the government chose to stick to its fiscal consolidation path, given all the other pressures to boost the rural economy, capex, the pay commission. The second is what actually happens to capital expenditure, given that private investment is quite weak, and the government did give some thrust to capex in the budget, and there's no place for that this year. Will some of these extra budgetary spending on capex as the budget proposes actually transpire? And the third relates to around some of the assumptions around asset sales. Will those materialize? If those don't materialize, what are the options the government has to make up? And finally, of course, what does all of this mean for the central bank in terms of its monetary policy trajectory going forward? So those are the 3 or 4 questions that I think are asked most frequently post-budget.
Let's just leave aside the first question as to what was the reason for the government to stick to the deficit. But the other one that I've discussed with people on the show recently is the fact that how is the government really boosting all this spending, especially capex and rural, while sticking to the fiscal deficit target? And B, actually at an aggregate level, because the data is very disaggregated, especially for example rural spending of the government. It's not given in one place. Is the government really increasing rural spending that much at all? So why don't we start there, Sajjid? What's your view?
Right. Prashant, so I think the first thing is a lot of people find a lot of reasons to quibble with certain line items in the budget. I think let's just step back and first give the government some credit. This was a very difficult decision. There were no easy policy choices. I think the government did the hard thing, but the right thing. And already you're seeing how rates markets have reacted. In the week before the budget, if you look at state bond yields, the spreads that they had over government bonds had almost tripled in the last 3 months. The dispersion was much higher. In yesterday's state auction, the average borrowing costs for states were much lower. We've seen GSEC yields rally as well. So clearly, it's had a very salutary impact on bond markets, and that's a very positive, apart from reinforcing fiscal credibility, both for ratings agencies and foreign investors. So I think that's just the starting point here. Now, in terms of line items, how did the government get here? I think there were 2 or 3 things. One is they've budgeted about 65% of the pay commission. So some of the pay commission has been pushed out to next year. We'll wait to see what the committee recommends. And number 2, clearly, as the government admits, on budget spending for capex has come down by about 0.2% of GDP. Again, not desirable, but faced with very few good options, they chose to go down this path, expecting that some of the extra budgetary resources from the NHAI, hopefully, and from the railways will help compensate. And the third is a harder question, because rural spending is so dispersed across the budget. But if you look at the main items, what you find is, yes, in terms of nominal growth, allocations have been increased, but if you look at it as a percent of GDP, they're basically flat. Again, I would say from a fiscal standpoint, that's admirable restraint that we haven't seen. There's been a lot of talk about a budget for Bharat, but in terms of allocation, the spending on the rural economy is the same as the percent of GDP as last year, and a lot of that is oriented towards infrastructure. For example, the Pradhan Mantri Gram Sadak Yojana has got a much larger allocation. So I think that's how the math worked, that you have to give up something on the rural economy, something on capex expenditures, something on the pay commission, and have higher asset sales, and that's how you were able to achieve the 3.5.
Okay, now, so you're saying rural spending as a percentage of GDP remains flat, same as last year. Capex spending as a percentage of GDP stays same as last year, right? 2.7, 2.8% or so.
Has gone down.
So
has gone down by 0.2% of GDP.
Yes. Okay. So, but largely flattish, right? It's not increased, at least. Let me put it that way. Both rural and overall capex spending. a lot of the spending has now been moved off the balance sheet as well, right? Now, which I come to the third point that you mentioned, which is rate transmission. What does it mean for rates? Which is that NHAI will borrow money. Indian Railways Finance Corporation, that entity will borrow money, and others as well. But they will borrow from the market, and this is quasi-government borrowing, right? So in that sense, has the end aim been achieved? That is the government sector still going to crowd out the private sector in terms of borrowing from the market?
Well, I think let's start by seeing how the markets reacted. So I think the market has all this information, and what you've seen is government bond yields have come down materially since the budget, both because of the expected borrowing this year and next year. Now, will there be extra sources of borrowing? There will be. I mean, NHAI every year were to raises some bonds. And if the NHAI didn't do it, then you would probably have private sector money also devoted towards infrastructure raising bonds. So yes, there will be alternative sources, but the worry was those things were going to happen in any case to some extent. And what the market was worried about is the center would significantly exceed this year's budget deficit, borrow much more, and then next year's deficit would concurrently be higher as well. So the fact that some of those tail risks in terms of what the total quantum of borrowing have receded, I think has had a very good impact. At the margin, will some of these infrastructure bonds contribute to diverting resources or using resources? Yes, but that's a good use of resources to the extent that that's being borrowed to build roads and finance railway construction. I'm not sure that's such a bad thing. So again, I said we'll always find small things to quibble about. I think the larger issue is something had to give. The government made the right choice. I'll just make one last point. The bigger worry for the bond market is not the 20,000-30,000 extra crore that NHAI will borrow. The bigger worry is what happens to state finances over the next 2 years, because states will now have these pay commissions. They have to pay the interest on their bonds. And will some of these Uday bonds be on-sold by banks? I think those are the larger worries in terms of supply going forward, more than the off-budget sheet capex financing that some of the quasi-government agencies will do.
Okay, fair enough. No, I agree. I mean, so states apparently will borrow some 3 lakh crores this year. On an average, they used to borrow about 1.2 lakh crores. So there's a huge increase, and plus that there is the Uday bonds as well that you said, right? But my point again, I'm not nitpicking here about like some 20,000-30,000 crores extra, but has the end aim been achieved, Sajjid? That's my point. Will rate transmission be faster, any faster, because the fiscal deficit has been kept at 3.5, or well, it won't? That's the point I was making.
So there are two issues here. One is, will any monetary policy transmission occur quickly to the long end, which is a separate question. But the proof of the pudding is in the eating. You've already seen bond yields go down by 15 basis points. So the curve has flattened, which already answers your first question, that sticking to the fiscal deficit number has reduced the 10-year GSEC yield by 15 basis points. It has therefore reduced corporate bond yields because that's priced off the GSEC. And it has reduced average and cut-off borrowing costs for states in yesterday's auction. So yes, already fiscal prudence has meant that there's been some kind of rally at the long end, and hopefully, future monetary policy easing, there'll be a greater chance of transmission to the long end. But of course, there are many other factors that drive that, which is, who's going to buy bonds? As you said, what will state issuance be next year? Will the RBI have to resort to open market operations to inject base money, or will that happen through creating base money because the balance of payment surplus will be larger? Will there be foreign appetite to buy GSEC? So there are many other factors that will determine where bond yields are 3 or 6 months from now. What happens to global rates, because Indian rates will move in tandem with what happens to global rates. But the fact is, the immediate impact of fiscal orthodoxy has already showed up at the long end of the curve by the rally you've seen over the last week or 10 days.
No, but is it here to stay, and will we see more? That's the point. That was the. So I mean, can the short end of the yield curve, for example, drop 15-20 basis points from here, Sajjid? What will that mean? By the way, AAA and commercial paper spreads have widened about 10 basis points since the budget.
Yes, but I think we need to be careful in the month of March because liquidity is extremely tight for seasonal reasons. So I would not overread what happens in the a couple of weeks in March. I think when liquidity normalizes from April, we'll get a much more stable, less volatile picture. And I think you need to judge those rates then. But Prashant, there are many things that drive bond yields. It's not just one factor. But if you speak to participants globally in India, the fact that prices are ultimately about demand and supply, and there was a risk that supply from the central government will be larger this year and in subsequent years, that risk has been taken off of the table. So that can only be good for yields. Now, what actually drives yields? There are 5 other factors, and all of that will contribute to the margin.
Would you agree that state borrowing is the single biggest thing bond markets will be focused on this year?
I think that is the reason the government doubled down on fiscal consolidation, because there is a sense here that there has been, I don't want to use the word loosely, but some deterioration in state finances over the last couple of years. Remember, states tend to lose revenues when oil prices go down because their revenues are ad valorem, unlike the central governments. So they've suffered from that. They've suffered from real estate markets being quite depressed, because that's another source of revenue. So you've already had some of those pressures play out in the last couple of years, and our sense is, despite getting a significant transfer from the central government, you've not seen much fiscal consolidation by states this year. Remember, the 14th Finance Commission transferred about 0.4% of GDP to states. It seems like most of that has been spent, though some of it could be on capex. And I think over the next 2 years, the issue is going to be very much on pay commissions, state pay commissions, and the interest that states will have to pay on their bonds. So you're exactly right. I think bond markets now will focus very much on what state issuances over the next year or two. But again, just the impact on state bond yields in yesterday's auction. Yesterday, the spread between state bond yields was 9 basis points compared to 25 basis points just 2 weeks ago. So some of the fiscal worries at the center had also directly translated into higher borrowing costs for states pre-budget, where larger states like Uttar Pradesh were penalized just because they were borrowing larger sums on that particular day. And some of that crowding out has alleviated significantly in yesterday's auction. So already fiscal prudence at the center has translated into lower borrowing costs for states.
So for our viewers, what you're saying is states now, to borrow money, latest data shows, are paying just 9-10 basis points over the central government 10-year bond, right?
No, what I'm saying is the spread. I'm saying that the 9 basis points is the dispersion between what the highest cutoff is and the lowest cutoff is in yesterday's auction. That dispersion had increased to 25 basis points. Weighted average bond yields of states are still higher than they were 3 months ago, but they are lower than they were 2 weeks ago before the budget. So average costs for states have come down.
But compared to 3 months back, how much higher are average state borrowings at, as compared to central government borrowing?
So there was a situation where back in October, the weighted average increase in borrowing costs for the states were about 40 basis points. That almost tripled to 100 basis points when there was a lot of bond market stress on Feb 22nd, of the week before the budget, and that's edged down a little bit yesterday. So borrowing costs are still higher than where they were 3 months ago, but they're less than where they were 2 weeks ago post-budget.
Is it still around the 100 basis point? Is the difference still about 100 basis points? Slightly lesser than that, maybe, but not substantially.
No, the weighted average cost has come down to about 80 basis points. So it's still higher than what it was back in October, but it's less than what it was over the last month or so. And I think we're almost done in terms of auctions for this year. So I think next year's cost for states will also depend on state budgets and state finances. Over the next month or two, we'll be getting a vast majority of state budgets. So it'll be interesting to see, what their fiscal deficit for this year, what are they planning for next year, how many states have already planned to keep funds aside for the pay commission. I think all of those factors will weigh on markets. But I'm simply making the point that state bond yields are also connected to GSEC yields because they're priced off that. So to the extent that GSEC bond yields come down because of prudence at the center and lower borrowing costs at the center, that also translates into lower average borrowing costs for states, because the spread may be higher, but they're still priced off the GSEC, which has come down in the last week.
Fair enough. Now, what is the RBI likely to do, Sajjid?
Our sense, Prashant, was that going into this year, given that inflation targets are quite aggressive, we have to hit the 5% inflation number next year and 4%, there was not too much space for easing, unlike the start of last year. Remember, the start of last year, inflation was running more than 200 basis points below the RBI's target for last January, 8%. Now we're already running, 50, 60 basis points higher than the inflation target for next January. The RBI's forecast still expects inflation to gradually come down, but we're many months away. There's uncertainty around all of these forecasts. So I think the RBI will be cautious. We had penciled in a 25 basis point cut at the April review. There was some speculation that with the government delivering on the fisc, maybe that was brought forward. That hasn't been the case, so I think we look for a 25 basis point cut at the April review, but not too much more after that. I think after that, the RBI is going to be very data dependent. We'll wait to see what the monsoon does. We'll wait to see what happens to global commodity prices, how food inflation in India pans out. And I think only later in the year, if there is sufficient conviction that we're going to undershoot the 5% target, I think will the central bank have more space to cut. So for now, we're just working with one cut at the April review.
Sticking with the RBI, or the operationalization of the Monetary Policy Committee and the changes which have been made to the in the budget, in the finance bill, have you looked at that? They all, broadly in line with what was already known. Anything you'd like to highlight?
No, just that, there's a lot of focus in the budget on, what the numbers are in terms of spending and revenue. A lot of small, very important institutional reforms. I think the Monetary Policy Committee is another very important step towards institutionalizing a monetary policy framework. The government and the RBI signed an agreement last year after the budget, talking about 4% CPI being the medium-term target. Now we've got an NPC, again, very, very positive. Apart from that, other things the government did, trying a direct benefits transfer for fertilizer subsidies. If you look at what that's done in terms of LPG subsidies, savings have been about 24-25%. And the Economic Survey did a masterful job in pointing out how much of the fertilizer subsidy goes into the wrong hands. So I think to the extent that we have now a trial and that DBT were to work for fertilizers, that bodes very well for rationalizing subsidies going down the line. There is, the budget spoke about automating 3 lakh fair price shops. Again, that sets up the architecture to eventually use Aadhaar at ration price shops. We don't have to move to a cash transfer. We can stick to a product subsidy, but if you use Aadhaar, you could again get the deduplication benefits, which have been in the order of 20% or so. So a lot of these little things that didn't catch a lot of the early attention, I think, bode very well for improving the quality of expenditure in the medium term on the budget.
Okay, fair enough. Let's just spend 2 minutes talking about the global environment. Global stock markets are off about 10% from their February lows. Commodity prices have rebounded significantly. What's the feedback from the global team, different teams covering these asset classes? What are we seeing? Just a rebound in a very weak scenario, and sometimes they can be very sharp. Or is this telling us it can be a virtuous cycle? Oil rebounding can lead to, better risk sentiment. I don't know, better demand or not, but better risk sentiment certainly. What's your view?
I think it's both a combination of sentiment and fundamentals. So there was a real concern in the G3 economies that they had lost a lot of growth momentum and activity had slowed meaningfully in the fourth quarter of 2015. What you've seen since then, however, is that labor markets, whether in Western Europe, whether in the US, you saw the last non-farm payrolls number, or in Japan, continue to tighten. So that suggests that growth momentum in those economies has not faded nearly as much as markets had worried about when they looked at the high-frequency data at the end of last year. So that was clearly a positive, number one. Number two, markets still believe that there's going to be more policy support, that even though the Fed, any rate hike now has been pushed to June, and even that's questionable, we expect the ECB to move this week. We expect the Bank of Japan may not move in March, but will most likely move in July. So A, you've got better data in the G3. B, you've got more constructive monetary policy support from some of these central banks. And C, as you alluded to, the fact that oil prices have gone up means that some of the tightening of financial conditions for commodity exporters has alleviated. Now, of course, oil going up, I think, has got its own story. There's talk about a meeting among some of the oil producers in March 20th of this month to talk about freezing production. So that could well be a supply shock. But the fact is, for the time being, oil going up bodes well for some emerging markets. So I think it's a combination of all these factors, that some of the tail risks to global growth that had been feared a month ago, that weakness in emerging markets is going to drag down the G3 as well, has not panned out. And I think what you're seeing is relief on the part of global markets.
Sajjid, it's a pleasure. Thanks very much for coming on the show today. Appreciate your time here, as always. Thanks very, very much.